Every great collapse in history carries two distinct sounds. The first is the cacophony of panic, the desperate ringing of exchange bells, the shouts on the trading floor, the silent screams of families watching their life savings evaporate. We know that sound. It is dramatic. It is visible. It is the story told in every history textbook. But there is a second sound. It is the sound of transaction. A methodical, quiet, almost invisible click that occurs not in the heat of the crash, but in the calculated surgical aftermath. This is the sound of the wealth transfer mechanism. For the vast majority, an economic crisis is a devastating loss. For a select few, those with prepared balance sheets, access to high-grade credit, and the patience of predators, the crisis is merely a clearance sale. A fleeting window where the true value of civilization's best assets, land, productive industry, vital infrastructure, are suddenly discounted to fire sale prices. This is not redistribution as a political act. This is consolidation as a financial certainty. A ruthless, almost thermodynamic principle of capital, that wealth, once in motion, will always flow from the weak hand to the strong. The question is not if the next crisis will come. The question is, whose hands are ready to catch the falling spoils? To understand the mechanism, we must first accept the cycle. History confirms this pattern is not an anomaly, but a feature of the modern financial system. The Roaring Twenties were built on a precarious foundation, soaring asset prices fueled by easily available credit, a belief system we call leverage worries. When the market climbed, every investor felt like a genius. They borrowed more, leveraging their wealth to buy yet more shares. But leverage is a double-edged sword. When the bubble burst in 1929, the small investor, often holding stock with borrowed money, was wiped out, not just by the loss of value, but by the demand to repay the original loan, the dreaded margin call. The titans of finance, however, often had pre-existing hedges, deep reserves, and, crucially, liquidity. They had the cash to buy when everyone else was forced to sell. During the Great Depression, while farmers were defaulting and banks were failing, a select class of industrialists and bankers were quietly buying land, shuttered factories, and the devalued stock of rival corporations. This dynamic proved catastrophic for the nation's social contract. The economic pie didn't just shrink, the slices were aggressively rearranged. From 1929 to 1933, the United States saw a staggering destruction of middle-class wealth, the foundation of the American dream. The powerful didn't just survive the storm, they used the low visibility to redraw the entire map of capital ownership. This wasn't merely a stock market crash. It was the largest single generational transfer of wealth that America had yet experienced. The pain of the masses was the discount rate for the elite. The 2008 crisis, the great financial crisis, offered a perfect, horrifying modern mirror. The underlying assets were different. Subprime mortgages packaged into complex debt instruments known as collateralized debt obligations, CDOs. But the leverage cycle remained identical. For years, vast institutions had used financial engineering to turn risky loans into what were labeled as AAA-rated assets. They convinced pension funds, municipalities, and even foreign banks to buy them. When the housing market cracked, the true nature of the risk was exposed. The entire shadow banking system froze. Now here is the key mechanism of the wealth transfer, the fire sale. When a leveraged institution must sell assets immediately to cover losses, they don't care about the true long-term value. They accept the best offer, which drives the price down even further. A loss spiral that forces everyone else to mark down their own assets, triggering more forced sales. Who buys in a panic? Not the retail investor reeling from losses, not the pension fund restricted by risk mandates. The buyers are the sovereign wealth funds, the private equity giants, and the hedge funds. The entities with access to limitless credit from the central banks, or with billions of dollars already parked in cash. In 2008, the government stepped in with trillions in bailouts, ostensibly to stabilize the economy. But by nationalizing the losses and socializing the risk, they effectively handed a blank check to the strong. They created a floor price for the assets of the elite, allowing them to offload their toxic liabilities, while letting the assets of the middle class, their homes and local businesses, sink to unprecedented lows. This wasn't just a crisis, it was a policy choice, a calculated act of saving the financial architecture by sacrificing the economic vitality of the working population. A new layer of concentrated wealth was forged in the fire of the Great Recession. And so, we arrive at the present, staring down the barrel of the future. As we enter the mid-2020s, the echo of 1929 and 2008 is deafening. Global debt is at historic highs. Asset valuations, particularly in tech and real estate, appear detached from underlying economic reality. The common phrase is the great wealth transfer, but often people only speak of inheritance, baby boomers passing wealth to millennials. But the other, more brutal transfer is already underway. It is the transfer driven by inflation and monetary policy. When central banks print money to stabilize a system, as they did aggressively post-2020, it devalues the currency. This quietly but profoundly punishes those who hold cash, rely on fixed incomes, or whose primary asset is their labor. In contrast, those who own hard, debt-financed assets, real estate portfolios, commodity stakes, private businesses, see their asset values soar while the real value of their debt shrinks. The modern mechanism is refined. It doesn't rely on a single dramatic crash. It uses financial repression, the maintenance of interest rates below the rate of inflation. The outcome is the same. The wealthy, leveraged owners get richer, while the savers and workers are systematically impoverished. The crisis of the 2020s and potential 2025 downturn won't just be about stock market volatility. It will be about the final consolidation of essential resources, water rights, critical digital infrastructure, and the rental market itself. The coming distress will create a class of perpetual renters and a class of consolidated owners. The quiet click of the wealth transfer is getting louder. The true lesson of the wealth transfer is not about villainy, but about structure. Financial crises are not random acts of nature. They are structural events rooted in the physics of debt and human psychology. And because the rules of the game, the rules governing leverage, liquidity, and bailouts, are written by those who benefit from the transfer, the outcome is statistically predictable. The powerful do not need to conspire to win. They simply need to wait. They understand that in moments of maximum chaos, the most precious resource is not gold, but optionality, the freedom to act when others are compelled to liquidate. The price of ignorance is the forced sale of your future. The price of awareness is the heavy responsibility to seek real assets, avoid excessive unsecured debt, and who'll hold the true north of long-term value against the seductive tide of speculation. The history of the 20th century taught us that recessions are temporary, but the resulting transfer of wealth is permanent. It locks in inequality for a generation. Pay attention to the panic, but listen closer to the silence that follows. That is the sound of the world changing hands.